Hello everybody and welcome to Options Discovery on John Lothian News' The Spread. My name is Alex Teng and I will be your host throughout this series. Just like you, I'm no expert, but with the help of some, we can learn more about options together. In today's episode, we go over how to use options to manage the risk of a larger portfolio and introduce the concept of hedging. We also get to sit down with Michael Oyster, the Chief Investment Officer at Options Solutions, to dive deep into the concept of using options as a tool for risk management while also talking about different ways to think about risk. You're going to want to stay tuned for that interview. Options are an interesting tool to use for managing the risk of a bigger portfolio, as they allow investors to take a position that offsets their exposure to some underlying asset. A common example of this is an investor using options to help protect a portfolio of stocks, or even a single stock, from downside risk. Often investors use a strategy called the protective put to help mitigate this risk. A protective put is a relatively simple strategy consisting of buying put options and owning an underlying asset. In the case of stocks, this usually means buying one put option for every 100 shares of stock that you own. To review, a put option is a contract that gives the buyer the right to sell an underlying asset like a stock, bond, or ETF at a specified price up to the expiration date. A protective put essentially limits the downside loss on a stock for the cost of the put premium. The best everyday product to compare this to is insurance, as you are essentially insuring your underlying stock from the risk of losing value. Alright, so let's give an example of a protective put on a hypothetical stock called XYZ. XYZ stock is currently trading at $50 a share and you own 100 shares. Now you're afraid that the stock will decline in value, so you buy out of the money put options at a strike price of $48 to protect yourself from the downside risk. The premium on the options are $3 a share. And just a side note, when it comes to picking a time duration for the put options, that is really up to the trader. There are options with expiration dates that range from weeks to years in the future. Okay, let's get back to our scenario. If the stock price goes up to $60 by expiration, then the put option would expire worthless and your total payoff would be the gain in the stock of $10 per share minus the put option premium of $3 a share. This would be a net profit of $7 per share, or $700 in total. See, you don't get to capitalize on the full appreciation of the stock because you bought put insurance, as you were afraid of the downside risk. Let's say that instead of increasing in value, you were right and the stock decreased in value to $43 a share. At a strike price of $48, your payoff per share on the put option is the gain on the put of $5 minus the premium of $3, netting a positive $2. Combine this with your payoff from the stock of negative $7 and your loss is only $5 per share. In this scenario, the protective put helped limit your losses on the underlying stock. In fact, your losses will actually always be limited to $5 per share no matter how much the stock drops in value because of the protective put. To really drill in this concept here, let's look at one more scenario. So let's say that the stock declined all the way down to $30 per share. And your payoff on the put option is actually going to be the gain of $18 you made per share minus the premium of $3, which is going to be $15 per share. And your loss on the underlying stock now is pretty big because you're going to sell the stock for $30, but you bought it for $50, which means that you have a negative $20 payoff. The total payoff will be the loss in the underlying stock, XYZ, of $20 plus the gain in the put option of $15, which again brings us back to our $5 net loss per share, or $500 loss. So you can see, no matter how much the stock drops, you're going to be always limited or protected from the downside risk past that loss of $5 per share. Now, as great as protective puts are, the premiums on put options can get pretty high. And one way investors deal with this problem is to use a covered call, which we've actually covered in a previous video, to finance a protective put. This strategy involves owning the underlying, selling an out-of-the-money call, and buying an out-of-the-money put. This strategy, called a collar, gives investors the ability to limit their downside risk by capping their upside potential on the underlying stock. This strategy works great if you believe that the stock is bound to decline, but you don't want to pay those expensive put premiums out of your own pocket. Okay, so both protective puts and collar strategies are perfect examples of how investors can protect themselves from downside risks on assets that they hold. One of the more difficult tasks for investors to do is to identify these risks and implement these strategies by creating structures for managing them. Our guest today is Michael Oyster, who is the CIO of Option Solutions and has had a long and successful career in the options industry as an investment manager and researcher. Michael is able to shed light on how professionals in the options industry think about risk and manage it in the context of an entire organization. So please enjoy my interview with Michael Oyster. All right, everybody, welcome to another Options Discovery interview. Today, we are lucky enough to have the CIO of Option Solutions here with us, Michael Oyster. Just introduce yourself real quick and give us a quick background of your education and career path that led you to where you are today.
Yeah, Alex, thanks so much for having me. I appreciate it. So, went to the University of Cincinnati for undergrad. After graduation, I started working in the options business for a guy named Bernie Schaefer, who you may know, kind of a legend in the options world and behavioral finance, really a pioneer in both of those areas. Spent 5 years with him, did a lot of quantitative research and a lot of trading. Went to work then for the institutional side of the world for an organization called Fund Evaluation Group, or FEG. Spent 19 years there, ended as chief investment strategist. At one point was the head of the investment group that was allocating multi-billion dollars in the form of outsourced CIO investment assets. So I've written 2 books on investment, various topics. Second one came out in 2018, and then got the opportunity to go to work for some really amazing people with Option Solutions, as you know, Bill Brodsky and Steve Sears and Bill Spath and others. So been enjoying that. It's almost been 3 years since we launched, since we started working together. So it's been great.
So today we're going to be talking about using options as a tool for risk management, which is, I guess, right up Option Solutions' alley. So the first question I have is, obviously this interview spawned from a great article you did on Forbes with Larry Light. If anyone's watching this, definitely go check that out. But one of the topics you discussed was about modern portfolio theory, which is the theory of being able to diversify your portfolio to an optimal risk return level. And so what you were saying in that article was sometimes using volatility as a measure of risk can be misleading, especially when you know, a lot of investors are conflating, you know, volatility with risk, and that obviously kind of leads into that short-term mentality we're talking about. Can you explain a little bit more of what you meant when you said these things?
Yeah, sure. So Harry Markowitz justifiably won the Nobel Prize for his work on modern portfolio theory back in the 1950s. He didn't win the prize then, obviously, but that's when the work was done. And that brought a whole new method and methodology to institutional investment portfolio construction. It's truly brilliant, truly groundbreaking. One of the common criticisms of modern portfolio theory is that the measure that it uses for risk is volatility. Now, statistically, that makes all the sense in the world. Practically, does it make sense? People don't really care about volatility on the upside. What they care about is volatility on the downside. I firmly believe that volatility is not synonymous with risk. Rather, risk is really the permanent impairment of capital. That's what people care about. They don't care about the short-term fluctuations, or at least they shouldn't. Many do, but you shouldn't. You should really care about the risk of permanent impairment of capital, which is to say something goes down in value and it stays there. It doesn't recover back up. That's when it really starts to hurt. That's the kind of risk that we have to protect against. And options afford us a great opportunity to hedge that risk with very prescriptive type strategies that can be exactly what an investor needs to protect against over the exact period of time over which they need to protect it.
Yeah, and that kind of leads into, how do you believe that options should be used in a risk management setting if we have to think about the dichotomy between volatility and the impairment of capital?
Sure. Yeah, I've spent a lot of time both in the institutional world and then more recently with Option Solutions talking to people about hedging risk and how to use options to do that. The simplest thing you can do is just go into the market and buy some put options, right? I mean, put options go up when whatever the underlying it is goes down, all things being equal. Puts are extremely expensive. And right now, if you look at the VIX above its long-term average, they're exceptionally expensive relative to history, even by its own standards. So what we do is, in general terms, we want to buy the puts, we just don't want to pay for them. So what we'll do is we'll sell call options out of the money and offset the cost of the puts such that the investor on day one pays nothing out of pocket, has the risk protection that they're looking for. So you say, well, what's the downside of that? Well, the problem is where you sell that call option, if the underlying security goes above that, you don't get any more than that, all else being equal. There's ways of mitigating that, of course, but that's sort of the trade-off. You're willing to give up some upside in order to get the downside protection for free.
Yeah, and when it comes to option solutions, one of the things that you guys definitely advertise to your investors is that not only are you able to hedge a lot of the risk that they have, but you're also able to generate income on assets that they already hold. Can you explain a little bit more of how you do that as well?
Sure, absolutely. So we've got a variety of different clients that we work with a variety of different needs, risk tolerances, goals, objectives, what have you. Some of our clients bring us concentrated stock positions. They were an executive at a publicly traded company. Part of their compensation package was in the form of stock. It's extremely low tax basis, and they never want to sell it, but it's just sitting there, not doing anything for them. So what we offer is a value proposition to them is to say, okay, if you're going to just keep this stock and you're never going to lose it, we can sell call options on it and generate a little bit of income such that it either replaces a dividend that doesn't exist for that particular stock, or it replicates or ideally exceeds the value of the dividend. So they're generating a little bit more income. One of the other things that we've done a lot of is clients will come to us and say, well, I've got this concentrated stock position, but I do want to sell it. I want to divest of it, but I need to do it in a responsible, structured way. So then what I'll do is I'll create a program that says, all right, if the stock goes up by a certain amount, you can sell a little bit of that. And I mean, that's just good fundamental investing right there, right? I mean, if you're going to divest of the stock, why not put in a position that says when it goes up in value, I'll sell it there. And oh, by the way, the client gets paid to wait until it gets sold. It's a great thing to do. So yeah, we do a lot of that. We've got some model portfolios that we've developed that screen stocks according to the price of the option relative to its fair value. So we're looking for options that are systematically overpriced relative to what the volatility of the underlying says that they should be. Those are juicy options to sell, and we use that to help our clients generate income from stocks that they hold.
Yeah, and so we're coming close to the closing part of the interview. So I have some questions for you that I usually end every guest with. And one of the first ones is, you actually talked earlier in the interview about some of the mentors that you've had. And what are some of the most important lessons that you learned either from them or on your own in terms of the options industry?
Yeah, for sure. So Bernie Schaefer was definitely a mentor of mine in the options business, as was Price Headley. I give them a great deal of credit for introducing me to options, which again, I knew nothing about when I started. Chris Meyer is a guy who hired me at FEG and has taught me over the years about being long-term, being consistent. Just sort of that farming analogy. That mentality came from him. I have a great deal of respect for Rob Arnott. I've met him a number of times with research affiliates, Cliff Asness of AQR. I had an opportunity to meet Ken French one time. I've had, Charlie Ellis. I met him. He signed my book for me. I quoted him in the book. So that was fun. But yeah, a lot of these guys that have been at it for a long time and just do the same thing. You know what you're good at, right? And don't try to be something that you're not. That's, I think, a lot of the mentors and people that I admire in the business have been very consistent about who they are and what they do, and they don't deviate from it. They don't try to be all things to all people. And I think that's what, lesson that I learned personally. Another thing, when you asked about lessons learned, the first thing that popped into my mind is when I was the head of the investment effort at FEG, we had a position that had currency risk on, and it really went badly. And one lesson that I learned from that was that when you're an investor, you have to take risk. And if you want better returns, you generally have to take more risk, but it's not necessarily a one-for-one trade-off. You've got to be able to determine whether the risk that you're taking is justified by a commensurate amount of return. Otherwise, you shouldn't take the risk. And I think that's the lesson that I've learned, is that yeah, you can take risk, and risk is important and risk is necessary to get return, but it has to be justified by a commensurate amount of expected return. And if it's not, you shouldn't take it.
Yeah, and I feel like that's something that we always hear as university students in finance, in investments. Theoretically, right? You need to find that all investors are risk averse, and you should, only take risk if you're compensated for it. But the practical implementation, that's a different story. Can you talk a little bit about that?
Yeah, nobody wants to take risk.
Yeah.
Nobody wants to take risk. Everybody wants to have the 10 to 15% return with no risk of the downside. And it's there's no free lunch, right? I mean, we all have to recognize that. But it's why we get paid, why we do what we do, is to try to find the nuances in those opportunities that present themselves. There are some that are structural, there are some that are opportunistic, and finding those and being able to take advantage of them when the opportunities present themselves is important. But I think at the end of the day, you just have to be comfortable. You have to understand what risk you're comfortable with. Like I said before, if you're not able to take a 10% decline in the stock market, you shouldn't be a stock market investor. So that happens fairly frequently, right? I mean, we've just seen it not very long ago this year. So, and even 20%. So I think it's just recognizing yourself, recognizing your own personal risk sensitivities, and aligning your investment strategy with those things.
Well, that was a great answer. And that is all the questions I have today for the interview. When it comes to some of the things that you've done, like your books, where can we find that?
Yeah, so it's on Amazon. If you look for my name, Michael Oyster, the name of the book is Success in a Low Return World. And I think it's can be particularly helpful in the current environment with interest rates moving up. That's kind of the premise of the book, is that the duration tailwind we've seen for the last 40 years is gone. There's an opportunity for investors to think differently. And then, of course, optionssolutions.com is where they can find everything about Option Solutions, about the team and what we do. And, of course, I'm on LinkedIn as well.
All right. Well, thank you so much for taking the time, Michael. We really appreciate you coming on the show and sharing your knowledge with us. And that is going to be it for today.
Great. Thanks, Alex. I really appreciate it.
Thanks. Bye. All right, everybody. I hoped you learned a little bit more about how to use options to manage risk on underlying assets that you may already own. I want to say thank you to Michael Oyster again for coming on the show and sharing his knowledge with us. And I want to say thank you to you as a viewer for staying tuned. All right, everybody. I'll see you in the next one. Bye. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.